Joining me now is CNBC contributor Fundstrat's Tom Lee. Tom, it's great to have you react to the president and what's happening in the market. So a framework to a deal, no force, all is well now for the bulls?
Scott, I think so. You know, I'd say on Monday morning before the open, I think investors were very concerned about Greenland and what's happened in Japan. And they thought of 2025 when it took 8 weeks for stocks to find their low, down 20%. So I think there was a lot of fear. So today's news really does do a lot to diffuse a lot of that anxiety. And I think it's wise to buy that dip.
Yeah, I mean, as part of this, of course, the president also saying no tariffs on Europe on February 1st. And that's what really upset the market. Are you still looking, though, Tom, as positive as you might sound for a bear market sometime around mid-year?
That's right, Scott. I think we have been pretty clear that we think that there is going to be a mid-year hiccup. It could be around policy or it could be around the new Fed being challenged. But that's coming from us markets being at a higher level. And I think one of the mistakes people make whenever they hear that commentary is they think it means to go to cash now. As you know, we've advised to stay invested and to buy the dip. But yes, there is a lot of good taking place in 2026, but we do have a lot that's already been priced in because of 3 good years of market gains.
What dip would you be buying specifically?
Well, for instance, I would be buying the dip on companies that have good earnings visibility or a structural reason to be long, because those that got sold yesterday, for instance, they're still the same great company. They were just 10% cheaper. I mean, to me, that's a stock I'd want to buy. The names I'd want to avoid are companies that are in the bullseye of White House policy, because we know last year, the White House picked winners and losers, created problems for healthcare and consulting companies. This year, it's credit card issuers, institutional buyers of single-family homes, and it's, some countries too. So I think that's the stocks to avoid. But I think fundamentally strong names, you still want to buy the dip.
I mean, it's complicated, though. You say that. You don't know who's in the so-called bullseye next. That's one of the problems.
100%. You're right, because if the White House decides that there's a company or series of companies that are creating problems for Americans right now, whether it's credit card bills or electricity bills, there could be action. As you know, one of the potential, quote, risks is data centers and their consumption of electricity. So that is something to watch.
I mean, you're gonna say, don't buy the home builders, because what if the home builders, he doesn't like home builders building homes and charging the prices they're charging? I'm just saying it's a slippery slope to start going down, where, in your words, you have an administration picking winners and losers. It certainly complicates the picture a bit, doesn't it?
It does, Scott. I mean, every administration picks winners and losers. Tom Block, our policy strategist, has pointed out that's what Washington's habit is, that they tend to pick winners and losers. But we do have a White House that is quite ambitious. They've accomplished a lot, but they're trying to accomplish a lot. So you're right, that's the risk. And perhaps one of these is enough of a tipping point to cause a broader pullback in markets. I mean, that's another possibility for why we'd have a drawdown that feels like a bear market.
But you still feel as though whatever upset we see or feel is going to be reversed and we end up having a pretty strong year?
Yes. In 2025, that 20% decline did not lead to a recession. And as we pointed out, that since 1950, waterfall declines that are not followed by a recession, and particularly a VIX hitting 60, have been symmetric recoveries. So I think if we have a, 6-week drawdown, investors shouldn't sell, because unless they're great at timing, we can recover all of that loss within 6 weeks. And we are expecting a really strong finish for the year. So,
Tom,
I think it's just...
Where does the Fed factor in to all of this? You heard the president with his obvious criticism of the current chair, Jay Powell, and some commentary on where the next chair may come from. How much does this matter to your outlook?
It's important, Scott. The Federal Reserve is the single most important entity in the world, and its independence is incredibly important because markets respect the Fed and they actually fear the Fed. So the independence matters. I think the process, and Steve recently made some good points, I think we're at odds increasing that it's the Fed that'll be respected because the multiple things taking place at the Fed now kind of limit how the White House can proceed to pick the new Fed chair. And actually, that's probably a good thing.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
This is our update for the week of March 30th. First, let me highlight some particulars. As of March 27th, the price of GRNI was $23.52, net asset value of $23.53, and total assets of $3.8 billion. The mid-cap GRNI, GRNI J, had price of $24.53, NAV of $24.56, and net assets of $352 million. And the income-oriented fund had price of $18.84, net asset value of $18.87, and total assets of $44 million. I want to notify you that we have been added to another advisor platform, Morgan Stanley. So thank you very much, Morgan Stanley. And Morgan Stanley joins many other advisor platforms that we're on: Stifel, Oppenheimer, RBC, Janney Montgomery, Carson, Raymond James, BNY Mellon, TD Ameritrade, Charles Schwab, Fidelity, UBS, LPL Financial. And of course, we are available on many self-directed platforms as shown here. Over the past week, GRNI fell 1.19% compared to a 2% decline for the S&P, or 91 basis points of relative outperformance. GRNI J fell 1% compared to a flat Russell 2000 2500, or 110 basis points of underperformance. And the income GRNI fell 1.22% compared to a 2% decline for the S&P, or roughly 88 basis points of relative performance. And on a year-to-date basis, GRNI is down 5%, the S&P is down almost 7%, which means 175 basis points of relative performance. GRNI J is down 3.83%, the Russell 2500 is flat, so underperformance of 370 basis points. And the income GRNI is down 5% year to date compared to a 6.68% for the S&P 500, or 170 basis points of relative performance. So let's talk about the macro. And the one macro thing I want to talk about is why the US can grow even with $100 oil. Now, I know we're in the midst of a fog of war, and the S&P is down 8% in February. And part of that has to do with the fact that oil is up 58%. Now, if you're pessimistic, you're not contrarian, because as you can see here, hedge funds have been shorting the stock market at the same pace they did in February 2020 and in April 2025. In other words, hedge funds are quite pessimistic about the US economic prospects because of this war. So let me give you some thoughts on why I believe the US economy is more resilient than that. Now, I'm not an economist, so consider this good enough for government work. Here are the 4 points in a nutshell why $100 oil doesn't break the US economy, and I'll go through each of these, but the point being, the US is a lot more resilient than many people realize. The first is that $100 oil today needs to be inflation adjusted, and when you do that, the oil price today is lower than it's been in the last 25 years. For instance, this is the nominal price of oil, what you pay at the pump or per barrel of oil. And at $106, it's near the peaks that we saw in 2008 and 2022, both times putting a lot of stress on the economy. But we have to remember, inflation reduces the present value of a dollar. And so when we inflation adjust crude prices, that's the lower chart here. And as you can see, the current price of oil is lower than it's been for most of the last 25 years. Again, that's good enough for government work. And here's another way to think of it. Think of the energy intensity needed to produce a dollar of GDP. And as you can see, it's fallen sharply in the last 35 years. The second is that the war actually stimulates the economy. You know, firing bullets and ammunition is expenditures, and that boosts GDP growth. In fact, if you look at the last 7 major U.S. conflicts, the U.S. has spent $1 trillion inflation adjusted in many of these wars. Of course, World War II, but Vietnam War, the Afghanistan War, the war in Iraq. And so that leads to the question, well, we've spent about $32 billion so far, but this could be $1 trillion of spending. And on average, that works out to about $32 billion a month. So that's all adding to earnings growth right now. So the question is, how much would oil have to rise to offset that? Now that's not a great comparison, by the way, because as I've explained before, the US is an exporter of oil. Therefore, rising oil is actually a boost to GDP, but let's ignore that for a moment. Here's a range of oil prices in gray, and then assuming 20 million barrels a day of consumption, how much does that increase the burden of oil to the economy? And as you can see, the higher the oil price, of course, the higher the monthly burden. But to match the wartime boost of 32 billion, WTI has to go to roughly 125. Now it could go there, but again, that would have to be a meaningful increase from the levels here. So again, good enough for government work. And then finally, keep in mind, stock markets are discounting mechanisms, and it turns out equity markets bottom very early in a war. In fact, over the 7 major conflicts I've highlighted, okay, the stock market bottoms within 10% of the duration of that war. I know that might surprise you, but take a look. This is the 7 major conflicts. But even World War I and World War II, the market bottomed within 5 to 8 months. And those were multiple 4-year conflicts. So bottom line, the US economy is resilient, but also it's a reminder not to try to time the market. And as far as how markets are being positioned, well, leading since the war started is energy. That's not a surprise, but notice crypto has outperformed gold meaningfully, especially Ethereum. And then tech and rate proxies have outperformed. So putting it all together, this is really basically what we've been recommending on the Fundstrat side: energy, crypto, tech, and rate proxies. So let's take a look at GRNI stock performance. The top 5 performers are energy and basic material stocks. Bottom 5 are hyperscalers and momentum names. Same thing with GRNY J. Top 5 performers are energy and basic materials, and the bottom 5 are basically AI and momentum related stocks. So on a thematic basis, the PMI recovery continues to perform well, and then energy and cybersecurity and easing financial conditions. So to me, this all points to the same notion that US relative growth is actually relatively resilient. Thanks for listening, and I'll speak to you soon.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.